You could be forced to sell that property. Your entire retirement savings are potentially at risk.
Commercial real estate's come out the winner.
Vacancy rates for industrial properties along the east coast have been increasing at a steady rate over the past 2 years.
For most of history, homes were places to live. Today, they're often treated as investments, and that one change may explain why housing feels so impossibly expensive. Not interest rates alone, not immigration, not greedy investors, something deeper in how the entire system works. So when did houses stop being homes? For most of the 20th century, a house served three purposes: shelter, family stability, community. You bought a home to raise kids in it, grow old in it, and eventually pass it on. Yes, it gained value over time, but that wasn't really the point. People bought houses to live in them, not to build wealth from them. Appreciation was a pleasant side effect, not the reason for buying. A home was where life happened, not a line item on a balance sheet. That model held for generations. Then it started to change. Over the past few decades, several forces converged at once. Interest rates fell for nearly 40 years, making borrowing dramatically cheaper. Credit expanded. Banks were willing to lend more against bigger loans to more people. Governments introduced tax incentives that rewarded homeownership and property investment specifically. Populations grew, especially in major cities. And financial markets matured to the point where real estate could be packaged, financed, and traded almost like any other asset class. Each of these forces on its own might not have changed much. Together, they transformed what a house actually was. Houses didn't just become places to live, they became wealth-generating machines. Once that shift happened, a home wasn't just judged on whether it kept the rain out, it was judged on its yield, its capital growth, its position in a portfolio. To understand why this shift accelerated, you have to understand why housing is so attractive as an investment in the first place. Housing offers leverage. You can control a $600,000 asset with a fraction of that in cash, then let the bank fund the rest. It offers capital growth, as prices have trended upward for decades in most major economies. It offers rental income, a steady cash flow on top of appreciation. It comes with tax benefits in many countries, from deductible expenses to favorable treatment on gains. And it offers something psychological: perceived safety. Unlike a stock, a house feels tangible. You can see it, touch it, point to it. That combination of leverage, growth, income, tax advantages, and a sense of security is hard to find in any other asset class. So, housing didn't just attract families looking for shelter, it attracted investors looking for returns. Once housing became an investment, affordability stopped being the only priority. A house could now be valued not by what a local family could pay to live in it, but by what a global pool of capital was willing to pay to own it. This is where the shift stopped being abstract and started being personal. When housing behaves like an investment asset rather than shelter, the dynamics around it change in predictable ways. Prices rise faster than wages because they are being driven by global capital flows and credit availability, not local incomes. Deposits become larger because the target keeps moving upward faster than people can save. Mortgages become bigger, stretching further into the future, 25 years, 30 years, sometimes longer, and younger generations enter the market later, if at all, often only with help from family. People aren't just competing against other families anymore, they're competing against an entire financial system. Investors, funds, and buyers leveraging cheap credit to acquire the same limited supply of homes. That's not a failure of effort or financial discipline. It's what happens when shelter and investment compete for the same asset. This pattern isn't confined to one city or one country. Australia, Canada, the United Kingdom, the United States, and New Zealand have all experienced strikingly similar trajectories. Housing costs decoupling from local wages, investor activity rising as a share of purchases, and younger generations locked out at increasingly higher rates. The specifics differ, the underlying pattern doesn't. This isn't a local housing problem. It's a global economic trend, the predictable result of cheap credit and capital mobility, meeting a fixed, desirable, and limited supply of land in major cities. Step back, and this connects directly to everything we've covered on this channel. As we explored in Why Rich People Keep Getting Richer, modern economies increasingly reward owning assets rather than simply earning income. Housing is one of the clearest examples of that dynamic in action, an asset that compounds in value for the people who already hold it, while becoming harder to enter for everyone else. As we discussed in Why the Middle Class Keeps Getting Weaker and Why a Good Salary Doesn't Feel Rich, anymore wages have not kept pace with the cost of entry into ownership, because wages were never the thing driving the price. Capital was. Debt, asset ownership, and inflation all point the same direction, toward a system that rewards those who already own and asks more and more of those who don't yet. Houses didn't suddenly become expensive. They became something else entirely. And once homes became investments, buying a home became less about finding somewhere to live and more about entering the world's largest wealth-building system.